Hello, this is Monica Sawyer. Welcome to Real Estate Investing for Women, where we focus on all aspects of real estate investing, including strategies, mindset, emotional mastery, money smarts, and so much more to ensure your success. If you'd like to learn my personal favorite investing strategy, just go to blissfulinvestor.com. You can also listen to this episode on the Real Estate Investing for Women podcast on iTunes. Now, let's welcome our guest. Today, I'd like to welcome to our show Mark Willis. Mark is a man on a mission to help you think differently about banks, Wall Street, and financial uncertainty. After graduating with six figures of student loan debt and discovering a way to turn his debt into real wealth, and watched everybody lose their retirement investments and home equity in 2008, he knew that he needed to find a sane way to meet his financial objectives and those of his clients. Mark is a certified financial planner, a #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with sophisticated, tax-efficient financial solutions. He specializes in building custom-tailored financial strategies that are unknown to typical gurus. A co-host of the Not Your Average Financial podcast, he shares some of his strategies for investing in real estate, saving and paying for college without going broke, and creating an income in retirement you can't outlive. Mark works with people who want to grow their wealth in ways that are safe and predictable, to become their own source of financing and to create tax-free income in retirement. Yay! Hello, Mark. Welcome to the show.
So glad to be on. Thanks, Monica.
I read this bio and I was like, yes, let's do this.
Awesome. Glad to be with you.
Yeah, I'm glad to have you. Could you start by just giving us a brief, kind of a little bit more of your story? I know you've got a daughter, your wife is involved in the financial industry, so give us a little bit more of sort of who you are.
I love having this life. It's a great life. We are living in incredible times. We have such opportunity to participate in the real estate space, to be your own boss. And for me, it was a passion around numbers. I guess I was a nerd after all, and I just never was told that. But the story starts after getting out of college. We did have six figures in student loan debt in the midst of the Great Recession. Was 2008 when I got out of grad school, and we had no plan, Monica, for how to pay that monster of a debt off. I mean, the monthly payments alone were like a mortgage payment to us. My wife and I said it almost felt like we had this chain around our necks. And yeah, it was in the midst of 2008, not really a great time to be looking for work right out of college, right?
I can relate.
Can you? Yeah.
Yeah.
All of my training, however, was like mutual funds, stock market, just buy term and invest the rest and hope and pray that the stock market will always go up. And I listened to the likes of financial infotainers on the radio, like Mr. Dave Ramsey and other friends. And we were plowing everything we could into our student loan payments. And we were feeling good about our rice and beans every night that we were eating for dinner. I mean, that was sort of our life for a few years there. And we never really stopped to think about the cost of paying off our debt. And a lot of folks have asked me, what's the biggest financial mistake that I've ever made? And I would say that it's going broke paying off our debts, which sounds sort of like a counterintuitive comment, but it wasn't until a mentor of mine came to visit my wife, Katrina, and I, and shared this strategy that we call Bank on Yourself, that a light bulb went off. And we started thinking, well, wow, wait a minute. We are essentially slaves to our debt. We're slaves to the bank. And every dollar that we throw at our debt is a dollar we'll never see again. And not only will we not see that dollar ever again, Monica, but we'll never see what that dollar could have done for us over our lifetime. Because a dollar today might grow to, $7, $9, $10 in the future, right? Mm-hmm. So you start putting those numbers together on top of the debt that we currently owed. That was a ton of cash. Mm-hmm. I mean, that's like a retirement account plus. And so we ended up getting so interested in our own finances that, we got our own money straight, and we opened up a practice in the midst of the Great Recession to say, here's some strategies, and here's some concepts, and here's a mindset for being better than debt-free, but actually becoming our own banker, becoming our own source of financing to help folks like myself, my wife, not only break free from debt, but actually control the financial environment where our money lives. So whether it's a student loan that we're trying to pay off, a credit card, or a mortgage on some investment properties, we've been passionate about getting the word out that there is something out there that's better than debt-free, better than just saving, as being a wealth accumulator.
Wow. So my head just blew up. You just said everything against what I believe. I can't wait to further this conversation. So let's dig a little deeper on kind of what's wrong with the traditional financial planning model.
Mm-hmm. Well, I've been classically trained as a CFP, certified financial planner. Mm-hmm. Everything they really present in our training and education, I took wholeheartedly. That, the white knight of Wall Street was going to come in and rescue us, but that isn't the case. I mean, if you look over the last 30 years, this is independent research, the real return of actual investors in equity mutual funds, this is according to Dalbar, and they have a long title, but it's called the Quantitative Analysis of Investment Behavior. And their annual study of real actual investors before taxes and before fees. Over the last 30 years, this shocked me, but the average return was only 3.6% in the stock market.
Yeah. Okay.
And that includes the 1990s bull market. That includes the last 10 years that we've run through, and our massive bull market in the last 10 years. And we've come up with a whopping 3.6% real return. And that's before taxes and before investment fees. So we're hardly even keeping up with inflation in the stock market. And yet, that's the only thing anyone ever tells us to do with our money. If we have $50 to our name, most investment advisors will tell you to throw it into a brokerage account or a 401k. So I was surprised when I learned that. Yeah.
A 401k that invests in mutual funds and stocks, right?
That's right. Yeah, that's right.
That's right. Yeah.
Like, would you like, it's like there's only one thing on their menu, and they can chop it up in multiple different ways, but it's the same answer, and that is Wall Street, and more Wall Street.
Mm-hmm.
So, we were just brought up with the truth that, we had to be kind of awoken, I suppose, to the truth that Wall Street, it's not written on any stone or there's no law that says we have to throw all of our money into Wall Street just to get to financial independence. Mm-hmm. So it was sort of that moment when I realized, wow, wait a minute, I've been throwing all of my money into a hole, which is our debt. And I've been hoping and praying that our rate of return would be higher, so we could someday get to a place where we can comfortably retire. So what's wrong with traditional financial planning? I think it's the myth of what's known as average rates of return. We can talk about that if you'd like. It's that fees on our investments are usually gobbling up, on average, according to the Department of Labor, about a third of our life savings. So if you have a 1% fee on your portfolio, that's 1/3 of your money gone over a 30-year period. 37% specifically, according to the Department of Labor. Can you imagine?
It's just painful. My goodness.
Can you imagine? Yeah.
No, I can't.
I mean,
actually, I couldn't.
Yeah. Yeah. I mean, think about that for the average person. That's a 6-figure lump sum going to an investment advisor, and he or she is going to get paid on your account whether the market is up, down, or sideways. They get a guaranteed chunk of your cash every single year. We don't have any guarantee.
Yeah,
right?
And a lot of that is not even disclosed. It's kind of wrapped up into, it becomes invisible, right?
Right. Yeah. So. And then really it became a problem too when it comes time to retirement. I started thinking about this too. What is investment advisors, what is their incentive to help you spend your money in retirement? As you're spending down the assets that's under their management, they're being paid less and less and less because there's less and less to manage as you're getting into your 60s, 70s, 80s. So they are not going to be returning your calls. They're not going to give you a full comprehensive financial plan if they're busy with helping other folks accumulate. To spend down your money is the most crucial part of your financial life. If you think about it, most people have a financial plan that's all about accumulate. But the goal of climbing a mountain is not to get to the top, in my opinion. It's to come back down safely, right?
Ooh,
85% of deaths on Mount Everest are coming down the mountain. And yes, the top is fun. It's a great view. But if my mountain climbing Sherpa assistant said, you know what, you're on your own, buddy, for the way down, I would be in big trouble. Most investment advisors don't have a clue and don't have a plan to help you spend the money you've accumulated in a way that won't make you run out of cash. I feel like real estate's a great way to help solve that problem, because that renter is going to give you that check for as long as you hold your property. I think there's other financial products and strategies that don't run out of cash, even if you run out of money. Like annuities, for example, are a great one for that. Pensions are another great one, as rare as they are these days. But it's, I think, in terms of traditional financial planning, long answer to your question, Monica, is just they don't have a plan. And how can we call it financial planning if there's no plan for how much you're going to have at retirement, how much you can spend as you go into retirement, how long that money will last? It's all a big weather forecast, and they have no control over any of it.
Yeah, it's so interesting because I do talk to a lot of people that are saying, well, I've been investing in my 401k, I've been investing in my ESPP, and I hope that I'll have enough. And the thing is that hope is not a financial plan, right?
I'm clapping, yes.
Right? It's, you know, a plan is a financial plan.
That's
and you
right.
bring up some really good points that even I hadn't thought about, because I've been in the accumulation phase. Right.
Mm-hmm.
And I kind of have often thought David and I would just self-fund. You know, we're not going to be dependent. We've built our real estate portfolio. We've been very active with our mutual funds and our stock. We've got sort of a diversified plan. So I sort of feel like we're handled because we're both really financially involved. Most people don't have that kind of time to spend on that,
right,
or the interest. We're kind of a numbers geek. We're kind of numbers geeks, right?
That's right. We're hanging out. That's right.
who has the time for that, right? And even us, with as much as we know, I had never really thought through those pieces because they're not really, I mean, they're far away. Right? When you get to the top of the mountain, when you're coming back down, well, that has been kind of far away. So I haven't thought about that. So such good points. Thank you for that. Yeah,
you want to pack enough food, so to speak, to not only get to the top of your mountain, but to come back down safely and plant your flag safely and securely back down at home base. Yeah. I feel like that's the best thing to do.
Yeah.
And good for you for paying attention to your financial life. I do think that it does take some more intentionality. Unfortunately, I feel like most people, they get the 401k when they get their day job and they never think about it again for 30, 40 years. And none of this occurs to them. And then all of a sudden they've got $250,000, $500,000 in their 401k. They've got all their money in their house. They have no guaranteed stream of any kind of income. And now they've got to figure out, what do I do with this $500,000 in a 401k so I don't run out of income before I run out of birthday candles?
Right. Unless they're listening to this podcast.
Unless they're listening. Yes. Amen.
They're thinking about it.
Good for you guys. That's awesome. Keep it up.
So talk to me about sort of your point of view on ROI. I know you've got a different definition for it.
Yeah. Return on investment. Again, I would say that average returns mean nothing. And first, I want to dispel the myth that average returns of the stock market have been 10% a year. We've already talked about real investor returns were closer to 3.6%, according to third-party analysis. Now I want to talk about why averages don't mean a thing. Let me give you a quick math example, and I'll try to keep this simple. If you're driving down the road listening, please don't pull out the calculators or anything. Wait till you're pulled over. But so let's imagine that you had $10,000, and let's say that you were able to double your money in the first year. That means you went from $10,000 up to $20,000, and you doubled your money. That's 100% rate of return. Sound good so far?
Yeah. Tell
Sounds
me how
great.
to do that.
Yeah. And then in year 2, we have $20,000 we're starting out with, but now we lose half your life savings. No bueno, right? That's a negative 50% in year 2. Now let's total it up. We went from 20,000, cut it in half. We're back down to our original $10,000, right? Over the 2 years, 100 in the first year rate of return minus the 50% in year 2, That is an average rate of return, Monica, of 25% over 2 years. So I just gave you an average rate of return of 25%. Don't you feel great? I mean, you've got 25% average rate of return, right?
Oh, what an amazing way to look at that, right? Because your numbers, you're still at $10,000.
That's right.
You're right back where you started, but
you're
25%.
right back where you started. Yeah.
Oh, interesting.
The average return means nothing. I mean, think of it this way. If I told you that the river in your town was an average of 5 feet deep, would you feel comfortable walking through that river?
No.
I would not. If I couldn't swim, I would not feel good, because averages don't account for volatility. And that's the real missing piece. And what's so crucial here, Monica, is that mutual funds are allowed to advertise average rates of return, which means nothing for the likes of you and me, who are just trying to figure out how much more money do I have this year than I had last year. Mm-hmm. For your listeners that are really wanting to geek out on the numbers, check out the internal rate of return or the compound annual growth rate. For the folks that really want to go deep into that, that's the right thing to look up. The compound annual growth rate is the true return, the increased dollars that you've received year over year over year. Most mutual funds won't tell you that, or at least you won't find it on their top, on their brochures. That's for sure.
Do you happen to have any average numbers on real estate?
According to Schiller, Price Schiller, the Schiller Index, it's about 1% above inflation, or about 4%.
Okay.
Yeah.
For real estate increases.
On the appreciation. Yeah.
And that's nationwide. Is that true?
Correct. Yeah. So don't forget all markets are local. Exactly. Mm-hmm.
That's right. Okay. So interesting. Yeah. Okay, great.
But rate of return is one way to look at it. My belief is we want a rate of income. I want a check in the mail every month. And what is the rate of the income that I'll receive? So that's my ROI. I'm looking for how much money will it take for me to generate a paycheck that I could never outlive, and in fact would begin to continue to increase over my retirement years to help keep up with inflation.
So I just want to interject here, ladies. ROI we normally think of as rate of investment, return of investment, right?
Right.
And what Mark is saying is that he looks at ROI as rate of income. So return on investment versus rate of income. And I love what you're talking about with the rate of income, because that's really the end game. Right? We don't care what we make on that money if it's not going to pay us.
Right. Mm-hmm. Well, even with real estate, even with stocks, there's really no return. It's just a change in the value. Until somebody sells that property, an investment is only worth what someone is willing to pay for it. Until then, all you have are paper profits.
That's right.
So don't think
paper losses.
Or paper losses. Yeah.
Right. Yeah. You don't lose money till you sell either. Right.
Right. So, that's right. Yeah. That's true. Yeah. So it's all about what someone's willing to pay you for it when it's time to sell. That's the return of your investment. Until then, it's just a change on a sheet of paper. For sure. And it's all about, in the meantime, how much cash flow can we get off of those tenants, or off of that property, or dividends off that stock. Until then, that's the only thing that matters, is the cash flow that comes from your holdings, your portfolio.
Okay, good. So what are some core questions you ask clients when they come to you wanting to put together a portfolio?
Yeah, some of the key questions are, where do you want your money to do for you? At the end of the day, I can't recommend something until I sort of know what they are looking for. What is their personal outcome? What do you see happening with taxes, for example? Is it okay to pay 1% a year to an investment advisor of your whole net worth, or 2%, depending on the portfolio, or 3%? What do you think about the access to the money? Do you want access to that money before you're 59 and a half years old? Do you want to have low cost accessibility of the money? Do you want that money to be open and available for creditors if you were to go through a bankruptcy? Real estate investors and listeners to the show, I'm sure, know that it's not if you are faced with a lawsuit, but a matter of when. Typically, over the course of a real estate investor's lifetime, 4 lawsuits is the average. So it's about, how do we protect the other money that's not tied up in properties, so that when you go through a unfortunate event like a lawsuit, how do we keep those dollars off the radar of the courts? So these are the questions that you'd want to start to ask clients and sit down with them and just figure out. Most people have an idea, but they've never been asked the questions. What do you truly want your money to do for you? A hedge fund makes your money act different than, say, a savings account would, or an annuity would, or a piece of real estate would. Mm-hmm. And it's about building, as you said earlier, Monica, a diversified platform to grow a true pyramid of financial wealth from the base all the way up to the top, and allocating accordingly.
Yeah. It is interesting because the big question that I've always asked is about liquidity, so, and you talked about this, right? But for you, it was just one of the pieces of the puzzle. So for me, I know that my real estate really isn't liquid. That's for the future. And then I have my other stuff growing so that it's more liquid to compensate if I have to put some more money in to hold on to my real estate, like in 2008, or if there's an emergency or there's something coming up. So that's kind of what we thought about. And now, as I'm learning through this podcast, we're thinking about a lot of these other pieces. So I'm glad that you asked those questions right up front about all of those pieces of the puzzle,
Yeah. Well, sometimes it's helpful just to do a thought experiment. Like, if you could be Pope of money for the day, if you could just wave a magic wand and create a perfect financial vehicle, what kind of characteristics would you want it to have? And I'll ask that to a lot of folks. And obviously some of the first things they say is they want a good, solid rate of return. They want it to be, available for them anytime they want, like you said, liquidity or accessibility of the cash. They don't want penalties and taxes to get the money out of the thing. They usually want some sort of predictable growth of the money, something that they can count on, like we talked about, a plan. They usually don't want a big, hefty expense or fee to manage this thing. They usually want it to be, again, protected from credit risk and predator risk. They typically want it to be available in retirement, tax-free, and they typically want some sort of management to pass it on to a future generation. I mean, all of those things in a way that doesn't, give half of it to the IRS.
Right.
So those are the usual answers I hear from folks. I don't know if you have any feedback on any of those things or would add anything to that.
No, actually, that was a great rundown. And those are similar questions to what my parents have been asking, what I ask now, those sorts of things. So that's really good. I want to move on to this concept that you have about banking on yourself. I love the way that you phrase that, and I want to hear more about what that means.
Yeah, well, it's a book that was written by Pamela Yellen a few years ago, and it was kind of introduced to me. And, funny enough, as I was going through my CFP, I'd never heard of this concept. But you can, as an individual, you don't need $200 million to go out and start an FDIC insured bank here. You can literally be your own source of financing for the small stuff of life, your vacations, your property taxes, your cars, your kids' education. You can become your own banker when it comes to your own real estate purchases. So I have many of our clients who are literally using their own banking system to purchase real estate and cutting out the mortgage companies, cutting out the private money lenders, cutting out the outside financing, and literally putting the money they would have sent to a mortgage down the street into their own pocket for their own financial future and their future of their kids and grandkids as well. And it's using a very old financial vehicle. And when I first heard about this vehicle, I was very skeptical at first. It's using a modernized form of this very 200-year-old vehicle that's grown like guaranteed every single year. It's using a whole life contract paid with dividends. In fact, it really hits everything that I just listed in that list of characteristics just a minute ago. Whole life insurance does that. It's available to you tax-free. You can get access to the money in about 3 days. It grows on a guaranteed basis every single year, no matter what's going on in the stock market. I mean, they've paid dividends into these policies every year for the last century, including the Great Depression. You can get the money out tax-free, and you can even pass it on to your kids, totally income tax-free. So it fits a lot of the boxes for using the policy in your banking life, like using it for the function of banking in your life. So before we get into the product and vehicle, I'll just say it does take a new way of thinking, Monica. It takes learning to think like a banker, to kind of see yourself as the banker on the other side of the desk. Usually we're sitting on the borrowing side.
Yeah.
Yep. But to think like a banker is to sort of change your mind and to change how you see yourself. But yeah, using this policy lets you borrow from the policy, like a line of credit to yourself. It's a big pool of contingency cash. If you've got $100,000, $200,000, $500,000, $1 million in cash value in this policy, you can then use that as capital for your real estate needs, or for your kids' college, or for anything else you might want to use, cars, vacations, whatever. And it just works, and it continues to grow even on that capital that you'd borrowed out. So it sort of allows your money to do two things at once, which I think solves some of the problems that many real estate investors I come across are stuck in, which is access to capital.
Mm-hmm.
What's that old quote from Mark Twain? He says, "A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain."
To rain?
Yeah. He's awesome. I love that guy.
My last name's Sawyer. I'm a particular fan.
I like that. Nice. Any relation? Maybe,
no,
maybe
but,
not. No?
But
okay.
my father-in-law is Tom Sawyer.
Is that right? Wow, that's amazing.
He's not the original, but that's his name. It's really kind of funny.
Love that. Well, so think of it this way. Like, if you had a permanent line of credit that you got the interest on, and you were able to use that for real estate in good times and bad, because we all know it won't who knows when it'll happen, but when the banks stop lending again, and when the lines of credit on our HELOCs and everything stop or are limited or are totally called, right? Who will be the real estate investors who will be most ready to take advantage of the next recession? It'll be the folks with big piles of contingency cash for the opportunities that present themselves. And for the folks that we work with who do have significant wealth in some of these policies, it's the money that they'll be drawing on to pay cash for real estate purchases.
Mm. So I have to confess, I'm very skeptical on this. So I would love to dive deeper, but we don't have all the time to do that right now. So tell me who this is a good fit for and who it's not a good fit for. Let's start there.
And believe me, I was just as skeptical. As soon as I heard whole life insurance, again, the Dave Ramsey in me, the alarm bells started going off and my mind shut off. And thank goodness I didn't get stuck in analysis paralysis, but it did take me about 7 months to overcome my own bias. And I was a CFP, I was, working on the investment track. I was helping clients out of the worst recession since the Great Depression. And I guess I was sort of watching the house of cards of real estate and Wall Street come tumbling down. So maybe that helped me sort of open my mind some. I would not recommend anyone just hop into any old whole life insurance policy. Most whole life out there is going to grow very slowly and not have any cash value in the first 5-6 years, 4 or 5 years, give or take.
Right.
So, you don't want to just hop into any old policy. It really, honestly, the shortest answer I can give you is work with a competent advisor who's been trained in the concept of bank on yourself, and work with someone who is willing to take a giant pay cut. Roughly about 70% of their commissions has to be forfeited, which is why as a CFP, I'm really proud to represent that strategy, because I do think it's in the client's best interest to not take giant commissions off a policy like this. Because those commissions are cut, Monica, the vast majority of your contribution or premium into the policy is available to you right away. So unlike old-fashioned whole life, which our parents, probably had, or grandparents might have had, these policies are 150, 160-year-old vehicle that's time-tested, but it's been modernized to be a lot more efficient. You get cash value in the first month, in the first year, the first few years, and it's available to you to use for real estate or other needs right from the start. So that's the shortest answer in the time we have. But all I'd say is my mentor, actually, when he kind of shared this strategy with me, he asked me, as my brow was furrowed and my arms were crossed, right? he said, Mark, is it possible that Dave Ramsey could be wrong about something? And he just sort of let that question hang in the air. And I had never considered that. But I'm sure for many of your listeners who are more critical thinkers than I was at the time, they may have already figured out that Dave Ramsey may not have written the 10 Commandments or anything like that. But you're right. If you have an open mind, I'd say it's worth investigating. It's not a good fit for folks who would prefer to use other people's money. It does take saving. Over time, you do get a significant accumulation inside the policy, but you will still need to save. So living within your means is a requirement. It's also never going to be 30% rate of return. It's going to be a steady cash equivalent. I've seen it somewhere between 4 and 7% after tax return, right? So not too shabby.
That's 4 to 7 after tax.
Correct.
So this is not apples to apples.
That's right.
Usually we hear we don't hear 4 to 7%. But if we were to hear 4 to 7%, understand that that's taxed. So
very observant. Yeah, you're right. The 401k, if it's doing 8 or 9%, it after tax might be only doing 4 or 5%. You're right. Mm-hmm. So given all that, I would say, take a look at it. Don't put all your money into something like this, and talk to an advisor that knows what he or she is doing in putting it together for you. That's the most important thing I could say in our short conversation.
So my audience we have a lot of younger women on here. We also have some older women like myself. And one of the concerns that I'm having jump in my mind right now is if whole life is actually a life insurance policy, and I don't know that much about it, premiums are going to be significantly higher for someone like me than a younger woman. Is that true?
Well, the way we would design it is very different from focusing on the death benefit. So yes, all things considered, someone who's 19 years old is going to cost less to the insurance company than a 69-year-old or 79-year-old. But the way we design it, it's really all about how much can I squeeze into this policy for the least amount of death benefit. We're cutting out all the expenses and the commissions, because all we care about, not all we care about, but the main focus of the policy is the cash accumulation. How much liquidity can we have in the first years? So with term insurance, you're thinking the mindset is like renting an apartment. I want to pay as little for rent as possible. When it's owning this policy that's going to build wealth for you, it's all about how much equity can I build up in this policy, sort of like owning a piece of real estate. So how much can I pack into this policy for as few expenses as I possibly can? And again, the purpose of the cash value is to keep it in motion, to use it right away. So for folks that are 29 years old or 49 years old or 69 years old, the death benefit will be higher or lower, but the cash value should accumulate roughly the same.
Interesting. Okay. I love that. Thank you.
Mm-hmm.
So we've got many more questions that I want to ask, and we'll continue that on the extra portion of the show. Now, why don't you tell my audience how they can get in touch with you to talk about all this stuff? Because there's probably many questions out there.
Yeah, it really complements the real estate portfolio. Again, I'd say maybe 40 to 50% of our clients are in the real estate investment space. Using these strategies is a part of a comprehensive financial plan that we would set up for folks. It's one strategy we specialize in. It's not the only thing we do. So the best way you could learn more about this concept is to check out our podcast. If you love Monica's awesome show, and I love your show, by the way. It's awesome.
Yay,
if you want to go deeper down this rabbit hole, check out our show. It's called Not Your Average Financial Podcast. And you can find us at notyouraveragefinancialpodcast.com. On the website, if you click request a meeting, we can chat for 15 minutes, just one-on-one. Happy to do that. I've got some time in the next couple weeks to chat with folks from your show. And if I can't chat with you, we'll connect you with one of our advisors, but I do have some time coming up. And if you'd like, just put Monica's name in the notes of the event, of the calendar event, and I'll be sure to send you a copy of our best-selling book at no charge at all, as long as you're in the United States. If you're outside of the United States, I'll give you a PDF, I guess, but I don't know how to get it outside. I haven't looked at how to mail stuff international yet, but otherwise, happy to chat with you guys.
Tell us the name of the book. I love it.
Oh, it's really how the same strategy works for e-commerce businesses. If you have an online business, the same concepts hold true. You need to buy inventory, you need to recycle capital. So the book title is How to Be an Amazon Legend and Fire Your Banker.
I just love that. And he's
put him out of work.
Copy.
Yeah, absolutely. Yeah.
That's going to be awesome. Okay, great. So Mark, are you ready for our 3 rapid fire questions?
Let's do it.
Okay. So start by just telling us a super tip on getting started investing in real estate.
Find one person like Monica who you can trust and just follow everything she says. Don't get too many mentors. Just find one or maybe two, but then just put all your, efforts into just following their system. Because if you get too many voices in your head, that's what, that's what medication is for, I guess. But just get one or two and then go after it and put yourself to the work, and it'll start to work. It's a downhill slope, and you start to pick up momentum really fast.
Nice. And then what is one strategy on being successful in real estate investing?
Yeah, I do think that there's a lot of good in putting your trust in other people, but at the end of the day, it is, what do you find that you're most passionate about? Because if you are being told to get into multifamily and you're all about, storage units, then you're going to have a hard time getting passionate about someone else's passion, right? So find what you're really into, what you're really focused on. What do you find yourself just reading about on the weekends? What do you find yourself just perusing YouTube to learn more about? And then just go into that and be okay with being weird, because that's what makes you you.
Mm-hmm. I love that. And that's such a big deal, because there are so many voices, right? And a confused mind can't decide.
That's right.
And if you go after somebody else's good idea that doesn't settle with you, it's just not going to work long term. You're going to burn out. So I love that advice. Thank you for that. What would you say is one daily practice you do, Mark, that contributes to your personal success?
Man, Audible is awesome. We're living in the future, Monica. I'm telling you, it's so cool. We get to listen to the voices of people who've given their lives to some topic or idea or strategy. I mean, come on, we're living in this incredible age where we have at our fingertips the wisdom of thousands of years, and we can never take it all in our lifetime. So yeah, taking a little bit of time. Usually it's after dinner when we're cleaning up the house. My daughter's put down to bed. I'll listen to some Audible every day, and that's been a lot of fun. Just trying to get into reading. As a busy parent, that's an important practice. No matter how busy we are, we can always find time to listen to an Audible book, is my opinion.
Yeah, I love that. So you're constantly learning.
Yeah. No, it's the best. It's the best way to put your dishwashing time to work for you.
Exactly. And I actually just found out that you can go onto the Amazon Echo and say, Alexa, play Real Estate Investing for Women, and it will fill up your house.
Wow. I had no idea. That's cool.
I love that. But you can do it not just for me, but you can do it for everybody. Like there's resources for us to have access to learning that's so easy. You don't have to download it all. There's all these different ways to do this. It's so awesome. I love it.
Oh, good.
Yeah. So Mark, thank you so much for sharing all of this great information and really making me think on some new concepts. And I definitely want to dive deeper on that. And we will certainly in Extra do a little bit more. But thank you so much for coming on and sharing all this with us.
My pleasure. Keep up the great work.
Thank you. And listeners, thank you so much for joining Mark and I for this portion of the show. If you are subscribed to Extra, stay tuned. We've got more. If you're not subscribed but would like to be, please go to Real Estate Investing for Women Extra.com and sign up. And if you're leaving us right now, I look forward to seeing you on the next show. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart most deeply desires. I'll see you next time. I hope you enjoyed today's show. If you'd like to download my favorite investing strategy, just go to blissfulinvestor.com. See you next time.